Okay, hello and welcome everyone. I'm Jason Gumpert from MSDynamicsWorld.com, and we're here for the final session in our Spring 2015 Financial Automation webcast series. Today I'm happy to welcome back a returning speaker, Bill Macbeth, Head of Research at Chainlink Research. Bill has some intriguing new insights to share on the future of supply chain finance, and we're always glad to have him back. Before we get started, I would also like to recognize our Financial Automation Series sponsors and thank them for their support of MSDynamicsWorld.com. They are Perceptive Software, Metafile, DocStar, Bottomline Technologies, and Avalara. So as we get started, please know that you can use the Q&A block or the chat that you'll see on the right side of the webcast session here to ask questions and provide your thoughts. Bill will be leaving time for questions at the end. So without further delay, Bill, let me hand it off to you.
Great. Thanks so much, Jason, and welcome everyone to today's session. I think it's an important topic, and supply chain finance is often treated as more as a tactical, executional function. There's, in general, in most organizations, some more strategic value that can be wrung out of it from the various groups involved in it. And so for today's agenda, we'll start out by talking about what we mean by full life cycle supply chain finance across the procure-to-pay cycle, and especially the role that network platforms play in supporting that. You're going to hear me talk a lot about network platforms as a key technology enabler of a lot of these new ways of supporting supply chain finance. Then we're going to dive into really kind of looking at the two aspects, the receivables finance that happens once an invoice has been approved, and the pre-ship financing is all the types of financing that might be needed by the supplier before the goods have actually been delivered and an invoice has been sent and approved. We'll touch briefly on some other benefits beyond the obvious ones, also on the core capabilities that you should be looking for from a network platform to support these types of supply chain finance capabilities, and then I'll wrap up with a little bit on things that you can do to actually get started with these kinds of programs. First question I want to pose before I dive in, though, is who actually owns supply chain finance? And it's not such an obvious answer. To start with, it is supply chain finance, so maybe it's a supply chain executive, but they actually often view it as primarily a financial function and may not realize the potential that supply chain finance has for assuring the continuity of supply, for actually making their supply chain more agile, and for bringing down the total cost of goods and the cost of the supply chain. Now, the folks in finance may take some responsibility, but they might not actually fully understand the role that supply chain finance can play in treasury and cash management, and there may be more value that can be squeezed by that organization as well. And finally, of course, it's important for procurement professionals as well. Oftentimes, procurement folks see their role primarily as sourcing, in the sense that, hey, I'm going to find the right suppliers and negotiate a great deal for us. And of course, that can be an exciting part of the job, and it's very important as well. But then once that's done, is how you're going to squeeze more value out of the relationship. And supply chain finance can be one part of that formula that can help improve your suppliers' performance and the financial health of your suppliers as well. So we're talking about full life cycle supply chain finance. Sometimes we call it holistic supply chain finance, which just means across the entire procure-to-pay life cycle. So I've got a timeline here that starts with the issuing of a PO, possibly, especially in the case of direct materials. Prior to that, there might be a blanket or master PO issued before the individual PO is issued. And then you've got various production milestones, again, particular for direct materials where you've got a manufacturing supplier involved. Finally, the goods get shipped and they're delivered either directly to the buyer, or if you're in a VMI relationship, they might be delivered to a VMI hub that sits next to the buyer's production facility. And in this case, I'm illustrating the VMI case where ultimately those goods get pulled from the VMI hub, consumed in the factory, an invoice is issued and approved by the buyer, and then payment is made. So this is your timeline against which we'll look at the various types of financing that can occur. A lot of people, the first one is receivables finance. That means financing of receivables for invoices that have been approved. And a lot of people, when they use the term supply chain finance, this is what they mean, and this is the full range of what they talk about. But there are a lot of other stages at which financing is needed or could be needed. If you're in a VMI hub, the supplier may not want to wait till the end, till the goods are actually consumed. They may need the cash sooner, so third parties can step in and provide financing during the period of time when the goods are in the hub. The same thing can happen for when goods are in transit. If the supplier needs their cash even sooner, there may be third parties willing to take the risk at a cost, of course, to provide lending, and in some cases actually take title to those goods while they're in transit and take on those additional risks, again, of course, at a cost. And finally, the suppliers might need cash even earlier in the process to procure materials and so forth for this particular order. And so pre-shipment financing that happens before the goods is shipped can be important for various suppliers as well. Now, in talking about this, I'm going to break it down into really kind of two pieces: the receivables financing that happens after the invoice is issued, and the financing that happens before that. So let's get started. Now, I mentioned the importance of a network platform, and I'll say a little more about what that is in a minute. It's basically a single platform to which all of the participants are connected. And so I want to illustrate a little here why this is important and how many different players might get involved in this end-to-end transaction. Starting, of course, with an issuing of a PO, which the supplier will receive and respond to and approve. But almost right away, if the supplier is looking for financing from, say, a bank or the third party early in the process, a lot of time that funding is based on performance against specific milestones. So they don't get all of the money at once. They might get the money in stages based on the specific production milestones. So the bank would like to have visibility or requires visibility into those production milestones in a way that's independent and instant. And network platform can provide that type of visibility for the banks. In addition, carriers get involved here, and starting with a shipper tendering a load. But what's that got to do with supply chain finance? Well, a carrier also can provide status updates throughout the progress of the goods as they're being shipped. And in some cases, if you think about the different Incoterms, that some of those events that occur, like it gets loaded on the ship, or even something as esoteric as the ship has passed a particular line of longitude, that can trigger a change in title and an actual financial event as well. So having that on a platform that everybody who has the access rights and the needs to see those events, it's much easier than having the carrier having to notify multiple parties through different channels. Same, of course, with sending an advance ship notification, and sometimes you may have a third party. So here's yet another party involved that's doing inspection of the goods when they arrive, either at the port or at the end destination or some point in between. And this third party will make sure that the right number of goods were shipped, that they're in good order, that there's no damage, and any other things that the buyer would like to, or the bank would like to ensure is in place. Now, in the old-fashioned world, that this inspector would create some documents that certify exactly what happened and send them via courier to the bank, perhaps fax them a copy, and that all takes time. So having them on a platform, first of all, provides instantaneous delivery of those documents, but it also provides a repository, for a historical repository, a single version of truth that everybody can look at and see exactly what happened. And so Proof of delivery is another thing that could happen on the platform and would trigger the generation of an invoice and that the buyer would respond to. The supplier may want early payment, a discounted early payment, and they might need the cash before the end of the terms that the buyer is willing to pay. So here a bank could step in and provide that as well. And finally, you've got the payment from the buyer, which will go either to the lending bank or to the supplier's bank. So you can see from this diagram that you've got a lot of interactions between a lot of players, and this is where having a platform, a network platform that all these players are connected to, can be extremely valuable in making all of these things happen more smoothly, more quickly, and providing lots of advantages. So here's another view of a network platform, which shows that essentially instead of having each buyer have to hook up and onboard all their suppliers, all of their financial institutes, all the carriers that they want to use, that these networks have all of the parties pre-connected, saving a lot of time and effort in onboarding, but also providing other mechanisms that really help, such as a single version of the truth. And in some cases, they also provide legal and executional frameworks that can help, and I'll get into what some of those are in a minute. So as I said, we'll start with the receivables financing and take a look at what happens there. So that in the traditional approach, if there's a supplier that would like to get their money earlier than the terms being offered by the buyer, is to go find somebody to buy their receivables. And these companies, these factors are around. There are some disadvantages to that, which I'll talk about in a second. Other approaches would include an early payment discount programs and receivables marketplaces. And of course, the early payments discount program is not dependent on having a network platform. That's been around for ages. You know, the 210 net 30, although the net 30 part is getting rarer and rarer these days. But that's where you know, there's an offer to pay the 2% discount for payments that are made within the first 10 days. But a network platform makes those types of arrangements work a lot better. Receivables marketplaces, where receivables, instead of the supplier having to go out and find one by one a buyer, can actually, up on the network, put the receivables and have lenders bid on them. So we'll talk more about both of those in a moment. But as I mentioned, traditional factors, it's often constrained because the visibility that supplier has into sources of funds, it's usually an in-country lender, and the rates are usually pretty high. So it wouldn't be uncommon, especially for an overseas supplier, to pay 10% or more for the short-term loans to provide cash for their operations. Now, if you jump over to the buyer side, and their treasury department is looking how to get returns for the cash they have on hand, and with interest rates what they are these days, you know, even struggling to get a 0.5% or percent is a struggle for them. And so there's this huge gap between the two, and by splitting the difference here, it can make it into a real win-win situation where the suppliers get early funding at rates that, you know, can be less than half of what they're currently paying, and the treasurer is getting, you know, 5 times or more their current rates for their cash on hand. I also want to point out that by having this platform, that with automation capabilities, and that's important that the automation is in there, it's an important part of the formula when we're talking about early payment discounts, because you want to streamline that procure-to-pay process. And so an example might be that when goods are delivered, an electronic proof of delivery from the third-party logistics providers, scanning and verifying the delivery of those goods could trigger the invoice process instead of waiting for the goods receipt document to be issued by the buyers system and make its way through the system. And there are many other examples of rules-based approaches to accelerating the whole invoice approval process. And what that does is it makes a larger and larger portion of the cash flow available sooner with longer discount windows, which gives both a higher set of returns for the buyer and earlier access to cash for the supplier. So my point there is that the automation is going to be an important piece of actually realizing this arbitrage opportunity and realizing a larger portion of it. So back to our three flavors here. We talked about the traditional approach. The early payment programs can be buyer-funded or third-party and / bank-funded, and they're typically managed by whoever's funding the program. The rates can be set by the buyers. That's most often the case of what the discount rates will be, but it's also some of these programs and mechanisms let suppliers set the rates. And the rule-based processing, we talked about the importance of that. As an example, Ariba provides something they call smart invoicing, and certainly there are many other platforms that also, most of these platforms actually provide rule-based processing. But these are many types of rules that you can set up, and what they do is, if the rules aren't met, then the invoice gets kicked back to the supplier until they correct the problem so that only clean invoices pass through. And beyond, this includes, of course, your three-way matching, but it could also include things like rejecting backdated invoices or ones that are not compliant with tax regulations and so forth. Another thing that many of these systems do, I know Ariba does this and others, is the dynamic discount. And so instead of having this single point that says, anything paid before 10 days gets a 2% discount and anything after that is full price, you can have an automatic sliding scale. Now, where this gets really interesting is when you have a lot of your buyers on a network, and the supplier can look out across all of these different dynamic discount possibilities. And I know Ariba's actually got this cash optimizer tool where a supplier can go in and say, well, I need $500,000 by Friday, and what are all the different dynamic discount opportunities available to me, and what's the cheapest way, you, the system, go figure out what's the cheapest way for me to get that cash based on these programs. Now, if we look at receivables marketplaces, so that is where a bank or a third party is funding it, and the supplier is supplier initiated. So the supplier puts up their receivables for bid on the marketplace, and then lenders bid on it, and that helps tremendously in driving down the cost to much lower rates than you get with a traditional approach. And companies like Prime Revenue and Receivables Exchange, and there are others out there that offer this kind of a program. So now let's shift gears, and we're going to talk a little bit about the pre-shipment financing and these different flavors. Now, one of the things I want to point out is that the further back you go in the process, the more risk there is for the lender. And you think about receivables financing, the supplier performance risk has been entirely eliminated from that because they've already delivered the goods, and the only thing that they're concerned about is the credit worthiness of the buyer at that point. Now, when you talk about VMI financing, most of the, actually virtually all of the supplier performance has been taken care of, and you're still mostly just concerned about the buyer's credit worthiness and that they're actually going to consume those goods and pay for them. In transit, you start to add the risks involved with logistics, and then pre-shipment is where you get into the supplier performance risk. Are they actually going to deliver the goods? Are they going to be delivered on time? Are they going to be the right quality? And so forth. And so to help lenders to get a handle on this, it's very important that these platforms provide visibility for the lenders across the entire scale here. And so this would be, they would get high confidence visibility because it's coming from actual data about which POs are issued and the amendments to those, the raw materials that have been ordered, these production milestones that occurred, the order was shipped, inspection completed, and so on. But perhaps even more important to that is the past performance. So if you have suppliers who've been on the system for quite a long time, then they start to build up a history that the lenders can look at. How is this supplier on-time delivery rates? How are they on quality? How often do they have inspection failures, and how critical are those? And all of those kinds of things. And if you add to that a legal framework that guarantees that the lender's going to get paid, and we'll talk about that in a minute, then you're left really just with the supplier's non-performance risk. And the ability for the lender to see into the past means that suppliers that perform well and consistently should get much better rates now, because you've given the lender that visibility that they can see that this is a low risk or a lower risk loan, and so that's an important piece as well. I want to talk about a couple other pieces. I mentioned the legal framework a second ago that are an important piece of the puzzle, especially when you get into the trade finance, but they can be important in domestic as well. So the legal framework is conceptually similar to a credit card network, and so you have a network provider that sets a bunch of rules and a framework of agreements that are actually signed by the cardholders, the merchants, and the banks, and they all have agreed to a consistent set of agreements that are really enforced by the network. So a similar thing happens here where the buyer commits to paying according to agreed terms, and the money that gets automatically transferred by the network on a specific due date. That's independent of whether the buyer has any outstanding commercial disputes with the seller. So this gives the lender a lot more confidence. They get this date certain payment. They've got visibility into the supplier's past performance, and this is another factor that goes into lowering their risks and therefore the rates that are paid. I'd like to also point out that disputes between the buyer and the seller become much less common because everybody's working off the same data. The system, a network like this provides a single version of the truth and, if you will, a supply chain system of record that's agreed to and that everyone has visibility on between all the parties. And that results, as I said, in a dramatic reduction in disagreements about exactly what was ordered, when it was shipped, what was received, what condition it was in, and so forth, because everyone's looking at the same data. We talked a little bit already about the competitive lending market places and the advantages of getting a much broader pool of lenders to bid on suppliers' business. That helps a lot. And the accurate and timely flow of documents, this is part of that automation. So when the automation can take the data from a purchase order and automatically flow it into create the shipping documents, and then that data is automatically used to create the invoice, and you eliminate all the rekeying, that eliminates another source of error, another source of delay, and so forth. And so these are all important pieces and capabilities to achieving your ends. And specifically, once all of these are in place, it really lowers the risk for the lender. You increase the competition for lending that money, and as a result of both of those, you get lower rates, actually much lower rates in many cases for suppliers. So you're lowering the cost of capital for suppliers, giving them funds earlier in the process, and as a result, those gains, or you will, those savings, if you will, can be shared, helping the financial strength of the supplier while also potentially lowering the cost of goods for the buyer. So you can really turn this into a win-win situation when you start to gain a lot of these advantages that we're talking about. I also want to talk about a little bit about risk and reduction of risk. We've talked about it from a lender's perspective, but the same thing can be said from the buyers and suppliers perspective. So what I've got on the screen here is your typical approaches and financial instruments that are available today that tend to be a zero-sum game, right? The risk is either put onto the supplier or it's put onto the buyer. So in the case of open accounts that are rising in popularity, so yeah, that's easier on the buyer, and it's quicker and less expensive than letters of credit. But now that the supplier has a significant collection risk, and especially if it's an overseas buyer, that can be a pretty painful process for the supplier trying to collect on those. You know, conversely, the letter of credit is significantly expensive and adds time and effort for the buyer, and advance payment is perhaps the biggest risk. It's put all of the burden on the buyer. So by taking this network-based supply chain finance approach, you can actually help reduce the risks for both parties, again, kind of creating a win-win situation. Let's talk for a minute about increasing the strength and resiliency of your supply base. So I picked this picture. I thought he looked like a pretty strong guy to represent that. So a good supplier risk management program, of course, it'll monitor the health of your suppliers, their health and financial viability. But really, it should go beyond that to put in mechanisms to help them when they're in trouble or short on cash. And a holistic supply chain finance program can make it easier for suppliers to obtain financing. It helps them obtain it earlier in the process, and it helps them obtain it at a lower cost of capital. And that could make the difference for a supplier that's in a cash crunch. That could make a difference of survival. So from a buyer's perspective, this could be really important, especially if it's a critical, one-of-a-kind supplier that's really hard or maybe even impossible to replace, that instead of the buyer having to step in and provide the cash and bail out that supplier, you've got mechanisms in place that help that supplier to keep going and to continue to serve you. And it's not just about the lower interest rates, it's also actually the access to capital, because it's not traditional supplier finance, so they're not faced with limitations of lines of credits and covenants and needing to pledge assets and all of those kinds of things to gain access to the capital. Instead, it becomes a much simpler process for suppliers, and it's built right into their sale to cash process. So it really is meant, these types of mechanisms and approaches are meant to complement rather than replace the supplier's existing bank relationship, and they can become an important component of keeping your supply base financially healthy. Another aspect that people don't always see right away is how this can help compress time to market and enable postponement of differentiation, which those of you who are not supply chain folks, I'll explain that term in a moment. So if a supplier has to wait until they have cash before buying raw materials, then when they're in a cash crunch, it can stretch out their lead times and slow down the supply chain. So early access to capital can actually help accelerate a supplier's production schedule, not just for buying raw materials, but they may even want to bring in some temporary labor to help fulfill those rush orders quickly and things like that. So it can really make a difference in compressing lead times and your time to market. But it also can aid postponement strategies. So what we mean by that, and supply chain folks I think are familiar with these deferred differentiation strategies, as they're sometimes called. And what it means is postponing certain key decisions until later in the process when you have much greater clarity and certainty about actual demand and execution in the marketplace. The actual demand in the marketplace. An example of this, of when it becomes a challenge, is in the apparel industry, where you have lead times that are generally longer than the actual selling season, and you've actually got to order all your goods before you've sold a single item. And so this is called a one-time buy. Now, usually or often the buyer has a pretty high level of confidence in what the overall demand is going to be, but they don't know the specifics of which size, color, and style mix is going to sell, which is going to sell better or not. And so what happens inevitably is they guess wrong, and they end up with their hot sellers selling out, and you've lost potential revenue because you didn't have enough of them, and then you've got too many of the slow sellers or the dogs, and you have to mark them down and you lose money on both sides. So what is a network platform that provides visibility and supply chain finance help in this situation? The first thing is that it can provide the confidence for the supplier that they've got a firm order in hand with those overall quantities. Since those are known early in the process, the buyer could actually place that order earlier than they normally would, and the supplier can now start to procure the goods and get them earlier. And then the other thing it does is the buyer has precise visibility into the supplier's exact production status, so they know when those decision-making points are coming. So for example, they know when the dyeing is going to start, and they know they have to make their color decisions by that date. They know when the cutting is going to start, they know they have to make their decisions about size and style by that date. And they might even decide to tell the manufacturer, well, just make half or two-thirds of my total quantities initially. Let's wait till we're in season and we're actually seeing what's selling, and then you've already ordered and have on hand all the raw materials. We'll decide what size and colors to make once we see the actual demand. And so all of these mechanisms can help postpone those decisions about what you're going to do and dramatically increase the sale of your hot items and reduce the loss you're taking on markdowns. So those are a couple of the non-obvious benefits that a approach like this to supply chain finance can give you, and start to pull in and see the value to the supply chain department and others. So let's talk for a minute about what you should be looking for in a platform and the types of capabilities that you will need to pull off the things we're talking about. So starting with this network platform that I keep talking about, I think one of the core assets of it is it's a many-to-many platform, and that allows the onboarding to happen only once and everybody to connect easily. So that's really important. One of the implications then is that security becomes critical, having highly robust and granular security, because you think about it for a minute, you and all your competitors are on the same platform. You've got all these really pretty confidential or highly confidential documents floating around. You want to make sure the wrong document doesn't go into the wrong hands. So part of it, as you're looking at these platforms, is to make sure they have not just very strong security that it would do encryption of messages at rest and in motion, but also that it has fine-grained control, so you can really control who gets to see what on the level that you want. And strong authentication, especially for sensitive transactions, that you can have a two-factor authentication. And as well, you want to make sure that their data centers are run properly and they have all the processes in place. So that would be something that would be important to look at. Another thing I've got here is this full procure-to-pay lifecycle integration. As you think about the things I've talked about, you need integration into your purchasing system, into your logistics systems, into your payment systems. And in many cases, these platforms actually serve a dual role. So in some cases, they're purely focused on supply chain finance, or perhaps just on invoicing and supply chain financing. But in other cases, they're actually providing a lot of those procurement functions or logistics functions. And in fact, what we see is some of these platforms, these networks, have a sourcing and procurement heritage. I mentioned Ariba as an example. Another one is TradeShift, that started as an invoicing platform, but they're expanding now into supply chain finance through partnership with C2FO. And there are others out there as well. And then some have more of a logistics heritage, but also work on the procure-to-pay cycle, and GT Nexus is a good example of that. So integration with the full procure-to-pay life cycle is important. In some cases, you may be looking for real-time, or it's actually more realistically near real-time visibility. So instead of depending on EDI documents and other things that can be delayed by days in some cases in appearing on the scene, taking advantage of more of the quote-unquote Internet of Things, or even just simple barcode scanning events that can help you know what's going on the ground in real time can be an important element as well. Now, as far as an executional framework, I talked about the importance of the automation, and that's an important piece. So for that, you're going to want something like a workflow engine, a rules-based workflow engine that can drive automation, document automation, and payment automation. So this should have all of the capabilities to check when certain things happen, when certain events happen, sending alerts when events don't happen, and triggering payments and other things when certain events do happen. In addition, you want to make sure that they can have the rules checking to make sure that all the compliance is there. And the best thing is that these rules should happen on the supplier side during execution so that supplier compliance is actually ensured, making sure that the right label is put on, that they're shipping the right quantity, the right location, using the right carrier, and all of those things. And that can really help take errors out of the system and streamline supply chain performance. And dramatically, the suppliers should like these because it can reduce the number of chargebacks they get due to non-compliance. It can also reduce delays through customs, making sure that you got all of the right documentation, and also it can help reduce supplier non-performance risk in general. So all of these things from the executional point of view, I think, are important. And last but not least, let's talk about the legal financial framework. As I mentioned, this really consists of a binding set of legal agreements that everyone on the network has agreed to. And this is really important so that you can automatically trigger the transfer of funds, the transfer of the titles. Everyone knows exactly what it is that triggers those, and all of those details have been agreed to with these agreements. It's really important that these networks connect financial institutes and provide a mechanism for competition. This could be, for example, allowing competition through having auctions of receivables and other things like that. We talked a bunch about the historical recording of events and the importance of that, the automation of payments and settlements, and having mechanisms for early payment discount programs can help as well. I want to mention this payment guarantees. Some platforms provide this capability. It's a mechanism so that suppliers can be protected. So if they perform exactly as stated, and the platform has confirmed that, has confirmed in the platform, then they're going to get paid even if the buyer goes bankrupt or for some other reason can't pay. Then the supplier ends up, they can collect their payment from the guarantor. So the platform can provide this ability for people to provide those guarantees for a fee, and for suppliers to take advantage of those. And because of all of the risk mitigation in here, it can lower the cost of those compared to, say, letters of credit or credit insurance, and that can be a valuable service. Last but not least, I want to mention the third-party ownership. This can be valuable if the platform allows title to be transferred to a third party temporarily. That's useful for VMI financing and in-transit financing. So just to wrap up here, I've covered a lot of ground here. We've talked about a lot of things you could do. And the question is, how do you get started? in a way that you're not trying to boil the ocean. A couple of pieces of advice here. First is, is you leverage what you've already got. Investigate and find out what programs and technology you have in place in your company, and build on those. Figure out, are they being fully utilized? Do you have more suppliers and relationships that can be added to them? Are there capabilities and mechanisms that you're not taking advantage of, along the lines of some of the things that we've been talking about? I'd also encourage you to quote unquote reach out across the aisle. So if you're in finance, you might want to reach out to your procurement folks and brainstorm about how you could get more out of those programs and what kind of things you could do in the future. If you're in procurement, you might want to bring in your supply chain folks to talk about and have they thought about how they can use these programs to reduce supply chain risk and compress their lead times and enable postponement and all of those things that you've learned here. And by getting more of the corporation aligned on these programs, you can squeeze more value and more strategic value out of these programs. I'd also say, if you're not on a network platform already, you really should consider joining one. In many cases, they can be joined at no cost or very low cost. In the case of suppliers, many of these networks don't charge suppliers, or even those that do, they may charge them only a transaction fee once they're actually conducting business on it. For buyers, it depends on how you're using the network. For light use, sometimes there's no charge. But as I mentioned, a lot of these networks have broader procure-to-pay or logistics capabilities. And so that investment may actually be part of a broader business case for you, not just supply chain finance. And now you would want to bring other folks into the picture potentially to look at making that decision about bringing in a platform that can help your company in ways beyond supply chain finance. And I'd say finally, check with your financial service providers, your banks and other service providers. They may have some programs that you could take advantage of related to some of the things I've talked about. So that concludes my talk for today. I'd be glad to take some questions. I do want to point out under the resources down below that we have a whole library of research, not just on supply chain finance, and we do have some reports that you can download on supply chain finance. We also have reports on other aspects of sourcing and procurement under the chainlinkresearch.com/SRM, and you've also got my contact information there if you want to reach out to me. So I think with that, I'll turn it back to Jason to see if we have any questions from the audience.
Thanks, Bill. Great stuff as always, and just to remind the audience, you can use the chat or the Q&A that you see to the right of the slides to ask your questions, maybe share some of your experiences in regard to supply chain finance. So one question, who are some of the providers of these network platforms you talked about?
Yeah, so I think I mentioned a couple of them, and I'll just repeat that. Certainly, Ariba might be one of the better known ones, and they have, of course, a complete sourcing and procurement suite and set of functionalities. But they've got Ariba Supplier Network. I think it's at last count that I heard was 1.6 million. It might be more than that by now. Suppliers and buyers on the network, but they also have they also offer supply chain finance in the form of dynamic discount services. TradeShift is an up-and-coming player that started in the invoice automation world, and now they've expanded their platform to the whole procure-to-pay and sourcing platform, and they're kind of doing it they're taking a different approach, building a platform that's more like what Salesforce has done with Force.com. So they're doing something similar to enable third parties to add on their components in a way that looks highly integrated with the same user interface and so forth. And so they recently announced partnership with C2FO for some supply chain finance capabilities as well. There's If you think about the trade finance, where you're talking about the end-to-end finance, including pre-shipment finance, I'd have to mention GT Nexus as one of the key players. Their heritage is in ocean logistics, but they've always taken this end-to-end view from managing purchase orders from the placement of the order to the payment, and then tracking it throughout the process, including production. And they've actually have a quite deep history. They've got folks they've hired from various banks and so forth that were trade experts, and of course they merged the trade card, which also had similar characteristics. So they are definitely one you'd want to look at. There are other players out there, Prime Revenue and Receivables Exchange, that will do the type of receivables marketplace I talked about. Talia's got some stuff, and there are definitely others as well. But that's just to name a few of the players that have these actual network platforms that have the supply chain finance capabilities built into them.
All right, great. And there was a follow-up to that. Are there specific products or industries that are better suited than others for these networks?
So I would say it depends on when we're talking about networks that are supporting the receivables financing, which is often these are invoice and payment networks and integrated with invoice and payment types of functions, or they could just be standalone receivables exchange type functions. That those are pretty horizontal because a receivable is a receivable. Now, of course, there are differences in buyer creditworthiness and so forth, but that really spans across industries. When we talk about the pre-shipment, and especially the trade finance, that tends to apply a lot more to manufacturing industries as well as import-export businesses, so perhaps wholesale distribution, because those are the ones who tend to get into the trade type of dynamics. And as far as specific products, I think that some of the things that I talked about very specific, like postponement of differentiation, those tend to work well for products like apparel and some others. But I think in many manufacturing industries, they can benefit by having visibility into production milestones and helping their suppliers that way.
Okay, let me make a last call for questions here. We have one more in the queue. So let's get to that one. How can finance and procurement and supply chain work together better on supply chain finance?
Yeah, it's a good question because these functions can be somewhat insular, and people can tend to look at just their own viewpoint on what supply chain finance means for their organization. So I think I mentioned that to sort of reaching across the aisle, and I think maybe this webinar helps, in pointing out some of the possibilities for those other organizations. And I think by doing that type of outreach and coordination with your other programs, you build broader support for these programs, so you're getting more leverage for the investment that you've made anyway to put these programs in place. And as well, you're able to squeeze, the title of this talk was about getting strategic benefits. And I don't want to overplay the importance, but I do think in many cases it's seen as a tactical, and this can help you look at how you can get value to strengthen your supply chain and reduce risk and help your treasury function and so forth. So I'd say just by reaching out and having those kind of discussions, you might be able to help the other departments to realize value that they didn't see was possible there, and increase value for the whole company.
Okay. Well, we are at the end of our question queue. We're going to start wrapping up here. I want to remind folks that they should look for a little survey that'll pop up as we end the session. It just takes 15, 20 seconds to fill out, but we really appreciate that feedback. Our speakers do as well. Well, Bill, thanks so much for taking the time to speak to us today.
Yeah, and I just wanted to mention one more thing. You can see my email address up there. If you wanted a copy of a PDF of this presentation, or for that matter, are interested in some of the reports besides going to our site, you feel free to send me an email, and I'll send that off to you as well.
Excellent. Well, with that, I'd like to just say thank you to everyone for attending today, and we will conclude the session. Have a great day.
Thanks.